Hello everyone, welcome back. In today's video, I'm going to be going over the YieldMax ETFs. And these YieldMax ETFs are a relatively new family of ETFs to the market. These ETFs are designed to give investors, whether that be dividend investors or income investors, a very high dividend yield. And before we begin, if you do appreciate this content, please like and subscribe for future videos. So as you can see by this scroller right here, there are quite a few different YieldMax ETFs, and the distribution rate is quite high, and that rate will change based on the ETF that you invest into. And here from the front page, you could see a variety of YieldMax ETFs that there are. You could basically get a YieldMax ETF on many popular stocks. You see all the way at the top the Tesla YieldMax ETF, and you can go down, there's an Apple YieldMax ETF, Nvidia, and even less volatile stocks like Disney and ExxonMobil, JP Morgan Chase are in there. And these YieldMax ETFs, as the name suggests, are designed to give a very high dividend yield. And right at the bottom, this is a very new YieldMax ETF, the YieldMax Universe Fund. And this is basically a YieldMax ETF that combines the YieldMax ETFs that they already have. So it's basically a combination of other YieldMax ETFs. Now, these ETFs generally do have a very high expense ratio, relatively speaking. Each one except the Universe one has an expense ratio of about 1. The Universe one has an expense ratio that is slightly higher, about 1.28%. And if we do look at some of the yields of these ETFs here, the distribution rate, you could see that some of the more volatile stocks that you have, like Tesla, will have a higher distribution rate, while some of the less volatile stocks will have a lower distribution rate. And that's kind of how these ETFs work because of their investing style. And I'm going to get into their investing style, and I also want to show you the dividend beforehand. Now, I'm not going to show you every single ETF because that would be a little unrealistic because there's many, but each ETF pretty much operates on the same basis. They have an underlying or a stock that it is linked to. So in this case, NVDY is linked to NVIDIA, and each of these ETFs are basically designed to pay monthly, and they're designed to pay, again, a substantial yield monthly. There isn't much dividend history here, so as you could see, the NVIDIA ETF doesn't go back that far, only till about June of 2023. And again, that is because these ETFs are a relatively new family of ETFs. So scrolling down on the fund page for TSLY, that is the fund that is linked to Tesla, we do see some distributions here, and these are pretty high distributions for dividend yield. I don't think there are many dividend or income ETFs that really match the distribution rates and the yield of these ETFs here. As you could see, the distribution rate for Tesla is, or TSLY rather, is 68.14%, which is an extremely high level of income and yield for an ETF. Now, I want to get into why this yield is so high, and pretty much a very, very important thing to consider before investing in this family of ETFs, because if you don't understand these ETFs and you're just chasing for yield, that is extremely dangerous as an investor if you don't understand them. So as I said before, I'm not going to go over every single ETF in detail because they all basically operate on the same premise. So this is the summary perspective for the ETF for Amazon that is linked to Amazon. And you can see that the fund's primary investment objective is to seek current income. And the fund's secondary investment objective is to seek exposure to the share price of Amazon. So you could basically see, as the name YieldMax suggests, is to seek current income. So investors that really want high income basically would want to invest in these ETFs because of their income potential. And then the secondary objective is to seek some exposure to the share price of Amazon because there might be a potential gain that Amazon has in stock appreciation. Now, with these ETFs, they are subject to potential investment limitations, or rather potential investment gains. So now, how do these ETFs operate? It's important to note that the fund does not directly invest in Amazon stock. So you're not going to have Amazon as the underlying. So that means although Amazon doesn't pay dividends, there would be ETFs in this family that do pay dividends, like JP Morgan Chase. The fund shareholders are not entitled to the dividends of these ETFs. And of course, that is kind of moot because the dividends compared to the gains that these provide via their investment strategy are kind of limited. So dividend investors really wouldn't care anyway, or income investors, because the yield is so high regardless. So a little bit of an overview of how these funds operate. I'm not going to get into too much detail here because the strategy is somewhat complicated, and it basically uses an option strategy which is derived from the shares of Amazon, or the share price of Amazon. So what they do is they sell calls, they short puts, and they buy long calls, and this basically comes down to something like a synthetic covered call strategy. So typically a covered call strategy is owning the underlying and then selling covered calls on the underlying, and you see that in an ETF like QYLG, if I remember correctly, that owns the underlying and then sells half of those covered calls on the underlying. This one does a synthetic strategy, which is similar to a covered call strategy, but it does not directly own the fund directly, or rather the stock directly. So scrolling down here, you can basically see how these ETFs work, how their investment methodology is structured. It's pretty much all options here. Again, they do use these options to create income and get long exposure to these stocks. So basically the important thing here is because it's not linked to the stock itself, and because we are also kind of doing these synthetic covered calls, there is going to be a limit to the amount of gain you're going to get from the price of Amazon here. Here it says that it will basically limit your gains to about 5 to 15% of the current price of Amazon. So that pretty much goes for any of these ETFs. If you're invested in Tesla with these ETFs, TSLY, then your gain will be limited to 5 to 15% of the price given that current contract. So if it goes beyond that price, it basically says here the fund will lose money on these short call positions, and the option will in turn limit the upside. So you're really not going to get huge upside with these ETFs. You're basically foregoing some upside for this income. And for some investors, this may be worth it. For others, not so much. If you're super bullish, for example, on Tesla, and you think it's going to go up 40 or 50%, then these options might not be right for you because you're going to limit that upside, and it might not be gained back from selling these derivatives here. So you're basically, again, exchanging that capital appreciation for current income. So basically what you are buying when you buy this ETF is you're getting purchased call options, short put options, and sold short call options, and some US Treasuries and cash. So as you can see, you are not holding Amazon directly whatsoever. Now, of course, with every one of these ETFs, which is kind of the reason why I don't recommend investing in them unless you really do understand what you're investing in, is that these ETFs are not diversified. Of course, at least the single ETFs that are linked to an individual company are not diversified. The universe one is a little bit debatable because it is basically a combination of all of these ETFs, but pretty much these ETFs on their own are not diversified. So you're going to get some extreme volatility as you would with the stock, but possibly even more so because of the derivatives. And now here's the caveat here at the bottom, which is what I want everybody to understand. The fund strategy will cap the potential gains of Amazon. Now this goes for every single one of these ETFs. So that means the fund is also subject to all the potential losses too, because if it's linked to the ETF or the stock rather, if the stock goes down greatly, this ETF will also go down. And this decline in the share price will not possibly be offset by the income received. So the fund may not be suitable for all investors. So a quick overview, kind of to recap, these are really high income ETFs, and there are various ETFs depending on which stock you are comfortable in being linked to. Some people are comfortable being linked to Amazon. Some people are comfortable being linked to JP Morgan Chase. Some people are okay with being linked to Tesla. Now, these funds are definitely going to be influenced by the share price of these companies. So again, if these companies go down, you are basically subject to all of the declines of these stocks, and that income might not be enough to overcome the losses of these stocks. Now, if you're comfortable with that, and I guess this is who these ETFs are suited for. These ETFs are probably suited for people that are okay with being in a specific holding, or they're going to own anyway. Like if you're comfortable with owning Tesla and you want income from that, and you're okay with being linked to the share price of Tesla, you're going to invest in it anyway, and you might not think it's going to go up that much. You might consider it to be okay to be invested in these ETFs. Now the thing is, these ETFs, this could work very well for you, or it could work kind of well against you. So in the case of the NVIDIA ETF, that is NVDY, this stock, this ETF, because the stock didn't really depreciate that much, has performed very well in terms of appreciation. And then you're going to have to remember that you're going to be able to keep the income from that derivative income. So investors that invested in NVDY are actually doing pretty well. Now this is the one that's linked to Tesla. You can see that investors that bought TSLY might not be doing as well. I didn't really add up the premium that you received from the income, so you might have come a little out on top. I know basically depending on when you invested in this ETF, it probably influences your return, but you can definitely see that these shares are definitely subject to some severe price depreciation there. And again, the income might not offset the loss from the capital depreciation. So it's definitely something to consider when people invest into these ETFs. Personally, I would never invest into one of these ETFs. I think that a lot of it's just chasing yield, and people might think these ETFs are safe because they're investing, for the most part, some of these ETFs are linked to highly volatile stocks, and then they think that they're going to be okay because they get this income. But you know, as the fund page says, the fund might not be able to offset from losses in the share price. So that's going to be it for today's video, everyone. I appreciate you all watching. Please remember to like the video if you did enjoy the content, and also subscribe for future videos. And I'll catch you in the next video.